X 100%. Engineer your financial freedom.
You ever feel like you're just throwing darts at a board with your investments? Well, today, we're going to unlock one of the most powerful, and believe it or not, one of the simplest concepts in all of finance: asset allocation. Trust me, if you get this right, you are setting yourself up for a much smarter financial future. So let's jump right in.
Look, if you've ever felt that investing is just way too complicated, or honestly, a little intimidating, you are definitely not alone. All the jargon, the crazy charts, it can really feel like you need a PhD in finance just to get started.
But what if I told you that there's a straightforward, totally proven strategy that helps you manage all that risk and grow your wealth over time? It's called asset allocation, and it's all about creating a simple, powerful plan and just sticking to it. No guesswork needed.
All right, so here's our roadmap. We're going to start with the why, the whole idea behind this thing. Then we'll get into the actual building blocks you'll be using. After that, it gets personal. We're going to figure out your unique investor DNA. From there, we'll build out a sample portfolio, and this is super important, I'll show you the simple secret to keeping it all on track for the long run.
Okay, first up, the Investing Balancing Act. Think of this as the main philosophy. It's not about trying to find some magic, one in a million stock. It's about engineering a smoother, more predictable ride for your money by balancing risk and reward.
So what is it really? At its heart, asset allocation is just the simple process of dividing your investments among different buckets or categories. The goal here isn't to pick the next big winner. No. The real strategy is to balance risk against reward. Because, and this is the magic part, when one of your investments zigs, another one often zags. So, what are these different categories we're trying to balance? Well, that leads us right into our second section, knowing your building blocks. Let's meet the three main ingredients you'll find in pretty much any portfolio. So you've got stocks, which are basically tiny pieces of ownership in a company. They've got the highest potential to grow your money, but they also come with the most risk. Then you have bonds. Think of these as a loan you're giving to a government or a big company. They pay you interest, and they're the steady, stable anchor in your portfolio. And finally, you've got cash. This is your savings account, super safe stuff. It's the safest of the three, but it also gives you the lowest returns.
This table really lays it all out perfectly. Think of it like this. Stocks are the engine of your car. They provide the growth. Bonds are your shock absorbers for when the road gets bumpy. And cash, that's your emergency brake for when you need ultimate safety. A really smart portfolio doesn't just bet on one, it uses all three to build a much more resilient ride for your money.
So, what's the perfect mix of those for you? Well, that brings us to the next big question. We need to find your investor DNA. This is where the strategy goes from being general advice to being truly personal. And the first, and maybe the most important question to ask yourself is this: how do you honestly feel when markets get choppy? Your gut reaction to seeing your portfolio value drop is a massive piece of the puzzle we call your risk tolerance. And hey, it's not just about gut feelings. Your ideal risk level is shaped by some very real-world stuff. Your age is a huge one. If you're younger, you simply have more time to bounce back from a downturn. Your goals matter too. Saving for a house in 5 years is a totally different game than saving for retirement in 30. And of course, your current financial stability and just your own personality play a huge role.
Okay, so once you have a handle on your investor DNA, it's time for the fun part. Let's actually build your simple portfolio using some really easy-to-follow models.
And the best part is, you don't need some super complex spreadsheet. You can start with a really simple rule of thumb, like 110 minus your age, to get a rough idea for your stock percentage. Or you can just pick a preset model based on your risk profile: conservative, moderate, aggressive. A really popular strategy, and honestly a favorite of mine for just how simple and powerful it is the 3-fund portfolio. The whole idea is to basically own the entire world market with just 3 simple, low-cost funds. And this chart shows you exactly what those risk-based models look like in practice. You know, a conservative investor, they might only have 30% in stocks, prioritizing that stability. A moderate investor might go for that classic 60-40 split. And an aggressive investor, who's probably younger with a long time to go, might push it to 80% or more in stocks to really maximize that growth potential. Now, theory is one thing, but let's make this real. Let's walk through an example and see how a fictional investor we'll call Sarah puts all of this into practice.
All right, so here's Sarah. She's 35, she's saving for retirement way down the road, and she's pretty comfortable with some market ups and downs. So using that simple 110 minus your age rule, she gets a target of 75% in stocks and 25% in bonds. It's a really good fit for her profile.
And check this out. Here's how she does it with that simple 3-fund portfolio. She puts half her money, 50%, in a U.S. stock fund. She diversifies by putting 25% in an international stock fund, and then she anchors the whole thing with 25% in a U.S. bond fund. That's it. So simple, totally diversified, and really powerful.
But wait, here's something that most people forget. Building the portfolio is just the beginning. The real secret sauce to long-term success is maintenance. So in our final section, let's talk about how to stay on course, especially when the markets get a little wild.
So remember Sarah's target, right? 75% stocks, 25% bonds. This is her North Star. This is the allocation that she decided was right for her goals and her comfort level.
But here's the thing, the market never ever stands still. So let's say stocks just have an amazing year. Because that part of her portfolio grew way faster than her bonds, her carefully crafted balance is going to start to drift.
And look at this. After that great year, her portfolio is now 82% stocks. Now, she didn't do anything, but her portfolio has automatically become riskier than she originally intended. So, how does she fix this?
The answer is a really simple but incredibly powerful process called rebalancing. So maybe once a year, or whenever her mix gets too far off, she does something that feels a little weird. She sells a tiny piece of her big winner, the stocks, and she uses that money to buy more of the thing that didn't do as well, the bonds. This little discipline is brilliant. It systematically forces you to sell high and buy low, pulling your portfolio right back to your target and managing your risk for the long haul.
So we've covered the why, the what, and the how. You now have a proven map that can put you in the driver's seat of your financial future without all the guesswork. So the question isn't just what's your first step, it's what's one thing you can do today, like right now, to start figuring out your own investor DNA and get this journey started.